Hey guys, I'm Phil Town from Rule 1 Investing. Today I want to talk to you about the biggest Fed rate hikes in 28 years and what they mean for our kind of investing. It's 2022 and we have not seen interest rate hikes like the ones we're seeing today since the early 90s. Wow, 30 years back. A few weeks ago, the Fed decided to raise rates by another 75 basis points. This is the fourth increase this year, won't be the last, and these interest rate hikes are an effort to combat inflation. It's still rising, maybe flattening out a little bit, we'll see. Value investors, that's our kind of investing, people are looking for a bargain in the market, need to know how these economic factors, that's both inflation on one hand and interest rates on the other, will affect your potential returns. If that's you, start by downloading my inflation ready checklist at the link below to see if you're on track. All right, so go do that. Now, what do the latest hikes mean for investors like you? Higher interest rates make money more expensive to borrow, which means fewer people and businesses are going to take out loans, which means less money will circulate in the economy. Now, the amount of money shrinking in circulation typically results in slower economic growth. Now, this is really good to combat inflation. When fewer people buy things, the demand decreases, prices tend to fall. However, when fewer people buy things, businesses make less money, they grow slower, they lay people off, which makes them less attractive investments. Now, this is even truer if we enter a full blast recession, which we just did. Now, with high interest rates and the risk of a recession on the line, many investors are choosing to just stay in safe assets like bonds. Now, this can cause stocks to fall even further, particularly if the baby boomers start going to bonds. The baby boomers drove this market up for 30 years. They can drive it down for 30 more. However, given present inflation, interest rates on bonds aren't nearly enticing enough to drive a lot of investors to convert their assets. Not yet anyway, and not yet because bond rates are going to go down. So what should you do? I like putting that's a bumper sticker. Keep calm and carry on. If you're a value investor, you should have confidence in the wonderful businesses you've invested in. Take a look at them. If they have massively inflated in price, maybe this is a time to collect your profit. If they're not vastly inflated in price, if they're still on sale, maybe this is the time to start thinking about buying more. So remember, our kind of investing is investing for the long term and continuing to practice patience. This is your greatest advantage. Try not to unload great companies unless they are vastly overpriced. You'll tend to do better in the long run if you hold on to them. Ask me how I know. Now, if you don't think you've invested the right way right now, don't wait. Download this inflation ready checklist. Do it now and see what you can do to protect yourself. Now, I'd love to hear from you guys. How do you think the big rate hikes will play out in the economy? Leave a comment below with your answer. I'll be sure and follow up with you, and thanks for watching. Now go play. If you enjoyed this video and you feel it was valuable for teaching you more about what the biggest Fed rate hikes mean for value investors, hit the like button and please share this video with your friends. And if you want more investing content, just subscribe to my channel. Don't forget to click the button on the screen. Got a free gift. And thanks again for watching.